Let's talk about the taxation on traditional IRAs. First of all, the contributions to a traditional IRA are always considered to be made in cash. The contributions are usually tax deductible, meaning you can use the amount that you put in your IRA, subtract it off your adjusted gross income, and use that lower amount to figure out your taxes for the year when your accountant, for example, is doing your taxes. Most of the time, they're going to be fully deductible. Sometimes they're partially deductible, sometimes even not deductible at all. Doesn't mean that you can't still make the contribution. It's just whether or not it can be used as a deduction on your tax return. Your tax preparer can help you with, where you're at in that situation. Tax deferred earnings is another great feature. All of the growth that goes into your annuity while you're owning it, you don't pay tax on that growth unless and until you take the money out. Another reason why people like to invest in traditional IRAs. Now, distributions, when you take money out of a traditional IRA, it's going to be income taxable for the year in which you get it. If you took money out of your IRA this year, you would pay income tax on it for this year on the growth that you take out. Early withdrawals from an IRA. You can take certain types of withdrawals before 59 and a half, that's what they mean by early, on an IRA without being charged the 10% penalty. That includes you, the owner, becoming totally disabled. They will let you take out money before 59 and a half and not make you pay that 10% penalty for early withdrawal. Catastrophic medical expense is another reason they would not penalize you that 10% if you're under 59 and a half. If you needed to make a down payment on your first home and then the amount can't be more than $10,000. And then the last one, if you're going to use the money from the IRA for post-secondary education, they will waive the 10% penalty if you're under 59 and a half when you take that money out. Rollover and direct transfer with an IRA are two examples of the proper way to move money from some other type of qualified plan into an IRA, for example. You want to keep all that tax deferral of the growth that you have within the one qualified plan and then moving it into the IRA so that you don't have a large tax bill at the time you move the money. So you have to follow all of the rules. Usually these things must be completed within 60 days if you actually have what is called constructive receipt, meaning they give you a check, say, from your 401k plan. You've got 60 days to roll it over into a rollover IRA, for example. The money has to be paid directly to the participant. If that's the case, they're going to automatically withhold 20% to be withheld by the payer for tax purposes. And then a 20% withholding can be avoided by making a direct payment into a new plan to do the rollover properly. Then you don't have to tell them to take out money for taxation because you're just going from like one transfer to another, from one qualified plan to another. So you keep all that tax deferral and you don't have to worry about any taxation issues cropping up.